All right, what's going on, guys? Today we're going to be talking about why it is a bad idea to invest in stocks like Verizon and AT&T. There are lots of stocks like this, but those are just two really good examples because they are such big, popular companies that a lot of people consider buying. And I've been that person that has invested into these companies because you might think, okay, these companies have a very reliable business model. They've been around for a long time, and you might make up whatever story you want in your head. But when you look at the performance of these stocks, you can soon realize that they don't go anywhere. So here's the last 10 years for AT&T, okay? The stock is down 16%, all right? If we check even in previous decades, we can see that. So in the around the year 2000, we had the dot-com bubble. That's why those companies went up so much. Then after that, from 2003 or so, the stock has pretty much been at around this, 22 to $25 mark the whole time. And so even as all these years go by, the stock never really moves much. And the reason that is because for one, these companies are very bad with managing their financial situation as far as like the balance sheet and the amount of debt they have. These companies have a lot of debt. And then the other thing, the main problem here is they are not growing their income fast enough. So here's the net income chart for AT&T, okay? So as you can see, I mean, 20, 30 years ago, it's not as relevant as the last 20 years or last 10 years. But even going back to the early 2000s, you can see that they don't the net income is not very consistent and it doesn't grow very much. Then if we go over here to the last, 10 years, 15 years, it's very inconsistent. There's years where they lose billions of dollars. 2022, they lost 8.5 billion. 2020, they lost over 5 billion. And there's some really good years. 2017, they made 29 billion, which is a lot of money. But that's not enough. One good year is not going to push the stock price up. That's not what it might push it up for a short period of time in that year, but if a couple months later or a quarter or two later the earnings are back down, well then that stock's going to go back down. So and keep in mind you have to deal with the whole market sentiment during this time. If investors have a bad sentiment around the stock, they're going to sell off the stock. So you can see that they did what 20 billion in 2010, right? Well, they did over a decade later, they still did 20 billion, and then now it's down to 14 billion, which they were doing, you know, almost 10 years ago. So it's like there's no consistency and there's no growth. Okay, those are the main problems. Let's look at Verizon's balance sheet here. All right. We're going to go to the financial statements, and Verizon is pretty much the same story as AT&T, but let's look at what their balance sheet looks like. So we have most recent quarter, we have equity of 93 billion. Okay. So actually in the previous years, we have 69 billion, 83 billion, 92 billion, 93 billion, which is good, which is great. The problem is, so remember, sometimes this company makes up let's say they make $30 billion as one of their best years of net income. Some years they're going to lose 5 billion, $8 billion. Okay. They have now the equity's up to 90. So I guess they're doing a good job in that sense. They are growing equity. I guess that's good. But when you're talking about $280 billion of liabilities, they have, what's their long-term debt? $145 billion. Okay. So they have $145 billion of long-term debt. And this company is going to average what, maybe $10 billion of positive net income on a pretty good year. So it's just their financial situation is not strong. And so, and here's the other thing. Here's why this stock it turns into a pretty big trap when you look at that 6% dividend yield. And as you can see, it's a 6% dividend yield and the payout ratio is 100%, meaning they're paying out all of their earnings to a dividend instead of paying down the debt. So it doesn't make it's just they're just not well-run companies. The other thing that makes it attractive is the P ratio is pretty cheap, right? A 4 PE of 10, that's pretty cheap. So when investors see a low PE and a high dividend, they're thinking, okay, and this is a big company that everybody knows. It's a reliable business. All that, they have nearly a duopoly, I guess you could say. And so it looks attractive, but then you realize the debt and you look at that they're not growing any net income. And even though you're collecting that 6% dividend, you're probably going to lose at least 6% per year on your shares, anyways. So it just doesn't make any sense. And I had to learn those lessons myself by investing in these companies, but I soon realized that they're traps. I got out of them. And that's why I think they are bad stocks to invest in.